All right. So as people are joining, let's begin. So, firstly, good morning, everyone, and thanks a lot for joining us. Welcome to our autumn economic forum. So, it's interesting times for the UK economy and for UK macro and the policy side, and that's what we'll be focusing on today. We're going to follow the usual format for this webinar. So we have two presentations covering the content of our outlook. So we'll start with my colleague Ahmet Kaya, who will talk about the global side, and then we'll hand over to Ben Caswell, who will talk about the UK economy and what to expect in the budget from our side. So we'll do those two presentations, then we'll kind of open the floor to Q&A, so the kind of normal formats. If you have questions, please post them in the chat. Do that as we go through, and we'll kind of allow you to ask your questions directly, so you can you think about that as you're doing it. But I'll remind you on that as we approach that point. So why don't we hand over to Ahmet to start with to talk us through the global picture.
Thank you, David. Good morning, everyone. So as David mentioned, I'm going to briefly present our global forecast and also talk about a few global issues that can affect the UK economy going forward. As always, this is a joint work within our macro forecasting team, and the contributors of our global forecast this time are listed on the screen. We use our global macroeconometric model, NIGEM, for our analysis, and if you are interested in forecasting and scenario analysis, either for the UK economy or the global economy, please do get in touch with us. With that note, let me start with our key messages. We expect global economic growth to slow compared to last year, but not substantially, as the fall in the US growth is expected to be offset by robust performance in several other economies. We have started to see the pass-through of tariffs to US inflation, but tariffs pose disinflationary effects in other countries. Going forward, the UK economy may potentially be affected by uncertainties regarding future tariff policies and a possible correction in the surge in the AI-related stocks. In our summer outlook, we projected global growth at 3%. With greater clarity on US economic policies and the initial impact of tariffs becoming visible, we have now raised our global growth forecast for this year to 3.2%. This upward revision reflects lower than actual tariffs, the postponement of the so-called Liberation Day tariffs, a broadly expansionary policy stance, the positive balance sheet effects of USD depreciation in emerging market economies, and overall stronger than expected first half performance in several economies. Among income groups, we forecast growth of 1.7% for advanced economies and 4.2% for emerging markets this year. For next year, we expect global growth to moderate to 3% as the full impacts of tariffs take hold. And this moderation will be broad-based, with growth falling to 1.5% in advanced economies and 3.9% in emerging economies. I mentioned that actual tariffs were lower than announced tariffs, and this chart compares headline tariff rates and the actual tariff rates based on the revenues from import duties as a share of total value of imports. Although the US effective tariff rates are at around 18% based on announced rates as of 17 October, the de facto tariff rate or the actual tariff rate is 9.2% as of July. This reflects exceptions of certain goods from tariffs and also trade diversions. So while we still think that tariffs are a huge negative shock to the global economy, we should also bear in mind that the announced numbers may overstate the actual size of the tariff shock. Furthermore, the US and China reached a framework agreement in trade policies last week. The deal includes lower tariffs on Chinese goods tied to fentanyl in return for a pause of export controls on rare earths and critical minerals for at least a year. This is, of course, not a comprehensive trade deal reversing all tariff policies, but a temporary truce that will ease some of the supply chain issues. Despite this positive note, we still expect US economic growth to fall from 2.8% last year to 1.9% this year. Although this slowdown itself reduces global growth by about 0.2 percentage points, higher growth rates in Japan and the euro area are keeping global growth relatively resilient. Our forecast growth rates for Japan and euro area are 1.1% and 1.3% respectively. In emerging markets, we expect China and India to continue growing strongly by 3.9% and 6.4% this year. However, we expect Brazil and Russia to grow slower compared to last couple of years. On inflation, we have started to observe some divergence across advanced economies. In the euro area and Canada, inflation fell to target levels, allowing a looser monetary policy stance that could support their economies against a weak trade environment. In Japan, low interest rates and a weak yen are keeping inflationary pressures elevated. However, there are significant inflationary pressures in the United States as we have started to see the inflationary effects of tariffs, particularly feeding into core goods inflation. And this is clearly visible in the chart on the right, which decomposes the consumer price index into imported and domestic components. As you can see, imported prices were significantly discounted before the Liberation Day, which also explains the import boom before the tariffs. However, after the Liberation Day tariffs, import prices outpaced domestic prices by 2.2% so far this year. This is estimated to add roughly 0.7 percentage points to the US CPI inflation by September this year. So this was our brief view on the global economy, and now I'm going to talk about three potential external risks that could affect the UK economy. The first one is ongoing tariff uncertainties. Although uncertainties have eased to some extent due to recent trade and investment deals, as you can see from the chart on the slide, they are still high relative to historical standards. And the existing tariffs are subject to change based on Supreme Court decision or the US foreign policy objectives. Although the current tariff rates are not particularly a huge source of concern for the UK due to lower overall tariffs, the UK exports may still be affected by the uncertainties regarding trade policies. In addition, a renewed escalation in tariff disputes, particularly around critical minerals, could feed into domestic inflation and intensify supply chain pressures. The second risk is related to the potential correction in the US stock market. The left-hand side chart shows that the price-to-earning ratio and the price-to-book values are at their highest levels since the dot-com bubble. As the right-hand side chart shows, this is largely driven by AI stocks, which have significantly outperformed the S&P 500 index since the Liberation Day tariffs. A potential correction could also spill over to the UK financial markets, transmitting volatility into domestic equities, affecting investor sentiment, and weighing on household wealth and consumption. And the final risk concerns the cool movement of the bond markets. The left-hand side chart shows the volatility in the US bond market, which is declining since summer, particularly due to greater clarity on the future interest rate path in the United States. Although long-term bond yields are rising in Japan, France, and Germany, the UK bond market seems to be more influenced by the developments in the United States. And it has also indirectly benefited from the Fed's return to the easing cycle. So I'm going to stop here with our forecast summary for the global economy and hand over to Ben for the UK presentation. Thank you.
Thank you, Ahmet. Very helpful. So Ben, when you're ready.
Thanks, Ahmet, for that presentation. So now turning to the outlook for the UK economy. So here is our roundup, our final forecast of this year. Really starting with our main messages, it's been a year of two halves. While the first half of this year started quite strong, momentum has slowed in the second year. And in that context, we forecast growth of 1.5% this year, followed by 1.2% next year. However, we anticipate that inflation has peaked now and will remain above 3% until spring 2026. However, we expect inflation to reach its 2% target on a lasting basis from the second half of next year, with a large fall in the headline rate in April. While the inflation outlook is normalizing, fiscal sustainability is the central challenge here. UK public finances are on an unsustainable path, and there needs to be a credible fiscal consolidation to ensure that public finances remain on a firm footing going forward. 5 years on from the pandemic, now is the time to start thinking about bringing the debt ratio down. So for our GDP outlook, this shows our forecast for the remainder of the Parliament. You can see that the strong growth at the beginning of this year, which I mentioned earlier, can be attributed to a couple of things. Firstly, some economic activity was brought forward in anticipation of the NICs and national living wage increases, and also in anticipation of tariff effects as well. In the second quarter of this year, government spending kicked in, so that also helped lift growth above trend for this year. So our belief of trend growth for going forward is 1.25%. So that's our belief on trend growth. And we have a box detailed in our outlook, which is box A, which explains where this figure comes from. So while we have growth above trend for this year, the remainder of the forecast, we have growth around trend, so averaging 1.25% going forward. Now, if we turn to the components of GDP, we can see where that growth is actually coming from. The best way to interpret these bars, which I'm showing you here, is to look at the left-hand side bar, which is the 2009-2019 average. So really you want to compare the size of the bars relative to that average. So you can see that 2025, the pink and the gray areas are quite large. So that indicates that government consumption and business investment were contributing to growth this year. However, if we look at the red bar, which is consumption has actually remained weaker than expected this year. And this is on account of a higher savings ratio. So consumers and households have actually been engaging in precautionary saving. Many households are trying to rebuild their balance sheet in response to the shocks of recent years. And this means that consumption has not actually recovered as much as we would have typically expected in an ordinary year. Turning to 2026, you can see that the government stimulus is fading away. A lot of the government spending that was announced in the 2024 budget was very front-loaded. So that stimulus starts to fade away. In addition, there is also a depreciation in the effective real exchange rate, and this makes exports more competitive, and we have a positive contribution from net trade next year. On the labour market, we know that the labour market has softened in recent months due to the fall in vacancies and labour demand. As a result of this, we expect unemployment to continue edging upwards and rising modestly. And we expect this to peak at 5.1% next year, which is just above its natural rate of 5%. For more information on how we calculate that natural rate, you can take a look at box E in our outlook, where we explain where we calculate this number from. In the context of wage growth, we forecast wage growth to slow next year, reaching 3.5% by the end of 2026. This is a rate of wage growth which is consistent with inflation being at target, and this will also help ease cost pressures for firms as the labour market normalizes, all the while still supporting consumption because real wage growth will remain positive next year. So looking at our inflation outlook, as I mentioned earlier, we believe that inflation has peaked. We don't expect it to rise further. And we also anticipate that it will reach the 2% target on a lasting basis from the second half of next year onwards. However, the main drop in inflation will come in April when some favorable base effects drop out of the calculation. This pace of slower inflation next year also represents a general slowdown in the economy, as I mentioned, moving from 1.5% to 1.2% growth next year. So this slowdown in economic activity and weaker demand and a softer labour market all are pushing in the same direction to ease cost pressures and keep inflation normalized. So with respect to monetary policy, some slack starting to open up in the labour market and vacancies falling means that there is a little bit of further space for gradual easing of the monetary stance. To this end, we anticipate 2 more rate cuts, one in the first quarter of next year, followed by a further cut at the end of next year, which brings us down to our R-star rate of 3.5%. However, for monetary policy to be effective, it needs to ensure that inflation expectations remain well anchored. Currently, both household and firm inflation expectations 1 year out are above their historical average and above target. This means that for monetary policy to stay effective, the stance needs to be sufficiently restrictive. This means that there is not a lot of scope for cuts, but real rates do need to remain mildly restrictive. And we anticipate that the Monetary Policy Committee will follow inflation down at a safe distance as a result of that. So our risks to our forecast can be described as follows. So on the downside, there may be renewed global cost pressures on account of geopolitical uncertainties, and also downside risk coming from the factors that Ahmet mentioned earlier, and also potential disruption from tariffs. We haven't seen those effects fully filter through yet. In the short term, there may also be a downside risk from a potential fiscal consolidation at the upcoming budget. While we're not speculating on what policies are going to be announced, there's wide consensus that there's going to be some kind of consolidation. And in the very short term, and I stress short term there, that can push down on demand. On the upside, there may be a faster than expected disinflation process ongoing, and that's particularly pertinent if the labor market continues to ease through slowing nominal wage growth on account of a looser labor market and lower labor demand. Also, in relation to the budget, if there is a credible fiscal consolidation and there is a clear outline for the policy environment going forward, namely the future path of tax and spend, that may also improve business confidence and consumer confidence, which can be conducive to investment and consumption as well. So turning to fiscal policy, which I'm sure you'd all like to hear about, given the context of the upcoming budget on November 26th, our fiscal forecast states that we think the government pre-measures, so given the tax and spending measures that were adopted in the last budget, and given what was said in the spring statement, pre-measures, we think that the government is on track for a 38 billion shortfall on its stability rule by 29-30. This is 3 billion less than our August forecast, which reflects slightly stronger GDP growth for this year, but it's broadly the same magnitude as where we were last time. Now, what we are forecasting here is the current budget deficit, assuming no tax or spend change. As I mentioned earlier, given the upcoming budget, there is widely expected to be some consolidation. So this is very much a pre-measures forecast. We're not speculating on potential policies here. So in the context of this, the way to interpret this figure is that this is our underlying assessment of the fundamental fiscal position. This is not our best guess of what number the OBR will arrive at in their forthcoming EFO forecast. So with respect to the fiscal shortfall, where does this number come from? 38 billion relative to the 9.9 headroom, which has been widely quoted from the March OBR forecast. You can see that most of this shortfall is driven by the trend growth assumption. So our belief about trend growth is 1.25%, while the OBR's trend growth is closer to 1.75% for GDP growth. So this is quite a substantial gap because this is a very powerful engine. If you have growth per annum 0.5 percentage lower, then you have a smaller tax take and you have a smaller economy in 29-30. So most of the shortfall is explained by that. The remainder is explained by the inability to pass the welfare reforms in the spring, and also some smaller components as well, like transfer payments and debt interest as well. So with respect to headroom, how much headroom is the right amount? So I think the way to think about this is to take a look at this chart here on the left. And this chart shows fiscal headroom as a share of GDP. You may have actually seen this chart, quoted in newspapers and media as well. And often it's been represented in cash terms as well. I think it's actually understating the problem if you present this graph in cash terms. And the reason is simply that 30 billion is worth a lot more in 2010 than 30 billion is worth in 2025, just on account of the economy growing, prices rising, there being inflation. So really the way you want to think about this is taking the fiscal headroom and then dividing it by GDP so you can express it as a size of the economy, as a share. And if I draw your attention to the last 6 fiscal events, you can see that they have been historically low levels of headroom as a share of GDP, less than 0.5% of GDP. Now, if you look historically, you can see that the average headroom that chancellors typically leave, historically speaking, is between 1 and 1.5% of GDP against their fiscal targets. So the last 6 events we've had after the pandemic have all left headroom much, much lower than previous chancellors have. Also, we have conducted some analysis on the optimal headroom using a few different methods, which we detail in box C of our outlook. And what we find through this analysis is that the optimal headroom to meet the fiscal rules with confidence going forward is around 1 to 2% of GDP. That's the kind of buffer that we need to be looking at to ensure that the fiscal rules are met credibly and consistently going forward. So it doesn't actually quite end there, as I mentioned in the first slide as well. There is more to fiscal sustainability than just meeting the fiscal rules. The real challenge is actually beyond this. The decisive issue is really about the sustainability of public debt. In other words, will public debt as a share of GDP grow unbounded? So to really understand this, we need to take a step back from the fiscal rules and zoom out and look at the broader recent historical trends as well as debt dynamics. So if I sort of direct your eyes to the chart on the left here, you can look at the surpluses as a share of GDP, historically speaking. Now, the primary surplus is the government's surplus minus interest payments. So this measure is basically just subtracting debt interest payments. And what you can see here is that we haven't run a primary surplus since 2001. That's nearly 25 years. And for context, there are people who I work with now that were born after 2001. So this is quite a long time ago. And what we can add to this graph, if we go to the next slide, we will see that we can overlay some interesting information here. So if we take a closer look, there are 2 types of debt regimes that the government can find itself in. It can be in a debt dominant regime, which is the world where R is greater than G. So the interest rate on debt is higher than the growth rate of the economy. And in that scenario, debt dynamics are not favorable because debt grows faster than the economy as a whole. However, if you're in the green zone, which is a growth dominant regime, then growth is higher than the interest rate. So naturally, the economy is growing faster than the debt. And just mathematically, arithmetically speaking, debt as a share of GDP will fall. But if you see here, we can even unpack a little bit more. During the 2010s, you can see we're in this green era of R being smaller than G, so the growth rate being higher than interest rates. And that's not a surprise because we know that interest rates were essentially rock bottom during the 2010s. However, during this 2010s period, debt as a share of GDP did stabilize and began to fall as a share of GDP in 2018 and 2019. So how is this possible? How was the government able to reduce debt as a share of GDP, even though they were not running surpluses? Well, the simple answer is that the economy was growing faster than the debt because debt interest was so low. But if you take a look at where we are today, we're not in this green zone anymore. We're in the red zone, which means we're in a R greater than G world, which is a debt dominant regime. In this world, interest rates are much higher and debt dynamics are less favorable. What this means is that if you're in an R greater than G world, which we are, then you cannot stabilize or reduce debt as a share of GDP without running a primary surplus. And I'll say that one more time to be clear. You cannot stabilize or reduce debt as a share of GDP without running a primary surplus if you're in an R greater than G world. So what this means for debt as a share of GDP, if we take a look at our next slide, it follows from this that the underlying fiscal position, the debt to GDP ratio, this is represented here in the black data. And there's 4 illustrative scenarios which show the evolution of debt when you run different sizes of primary surpluses. So these range from 0 to 3%. As you can see, as you project forward, given our growth forecast, you can see that just to stabilize the debt, you need to run a 2% primary surplus. And to make the debt fall, you need to run a 3% primary surplus. To convert this back into the terms of the fiscal rules, just to make a useful connection between the 2 points, the gap between the primary surplus and the current budget surplus is about 1% of GDP. So in other words, if the Chancellor has a 30 billion headroom on her fiscal rules, that's equivalent to approximately 2% primary surplus. If the Chancellor was to have a 60 billion headroom on her fiscal rules, that would be equivalent to approximately a 3% primary surplus. So that's the context of what we're talking about here. So to return to our key messages, for this year, we have growth of 1.5, followed by 1.2 next year, and inflation above 3% until the spring, but on target by the end of next year. However, the government faces a serious fiscal challenge in the upcoming budget, with unfavorable debt dynamics, R being greater than G. The government needs to build a larger buffer against its rules. And what we're suggesting here is a buffer of at least equal to 1% of GDP. That means a 30 billion headroom buffer on the fiscal rules, equivalent to approximately a 2% primary surplus. 5 years on from the pandemic, now is the time to start thinking about bringing the debt ratio down, and the costs of not acting now are high. You may have heard of the saying that it's good to fix the roof while the sun is shining. Well, as you know, living in the UK, the sun doesn't shine very often. Therefore, my offer to you to extend this metaphor is that it's better to fix the roof in light drizzle rather than trying to fix the roof during a thunderstorm. We don't know when the next big economic shock will be. And 5 years on from the pandemic, given the fragility of the fiscal position, now is the right time to start bringing debt down to safeguard the economy for whatever future shocks may come next. And that concludes our outlook for the UK economy. Thank you.
Thank you very much indeed, Ben, and Ahmed as well, both very clear. So we can now turn to some Q&A. So if you do have questions, the best way to do this is put them in the chat, and then I'll call on you and you can ask those questions directly. I think while they come in, I can see that there's one in there already. I might ask a couple myself just to give you a little bit of time. So maybe this is a question, it kind of cuts across both of your talks, but I'll address the question to Ahmed. You showed us, this fascinating development we've seen in the US Treasury market, where Treasury yields, surprisingly perhaps, have fallen quite a bit. They dipped below 4%. I think they're up a little bit from there. You mentioned that there's a kind of a tight correlation between US yields and UK gilts, and then that links to what Ben was telling us about these R minus G dynamics. Like, what's actually going on in the US Treasury market? Why have we seen this kind of fall in yields recently? Is this something that we should expect to be persistent? Kind of cuts across some of the US fiscal dynamics, which also look a little on the unstable side, plus issues around Fed independence as well. So what could you say about the causes of these kind of developments in the US Treasury market?
Thank you, David. I think, it's quite difficult to answer this question fully, but maybe I can try answering that, relating it to future inflation expectations and Fed's interest rate cuts. So essentially, after maybe 5-6 months, Federal Reserve started to cut interest rates again in summer, and they also cut one more last time, and also clarified what they're gonna do in the future. So bond yields have two main components. One of them is the inflation expectations. The other one is the risk premium. So what we saw in the beginning of this year was a huge jump in the risk premium because of all these tariff worries, etc., etc. And the second thing was, again, inflation expectations was higher in the first half of this year because of what we were thinking is there will be a huge inflationary shock because of tariffs, etc., etc. So since then, two developments I think had the bond markets in the United States. One of them is the inflation expectations fell not sharply, but to a certain extent. And that's linked to tariff being maybe not so inflationary as we feared initially. The second thing was thanks to all these trade and investment deals, the risk premium component of the bond yields in the United States have also fallen. This is also related to the one of the charts that I showed, the difference between actual tariffs and the announced tariffs. We saw a kind of a huge gap between them. So essentially, the worry related to the tariffs were not so high. So of course, we need to be careful about tariffs. Of course, we need to take them seriously, but perhaps we may have overstated the announced numbers. So coming back to the UK, what we have seen is the UK bond market is pretty close linked to the US bond market. That's both because of the holding of large-scale US treasuries in both the financial sector and also household sector in the United Kingdom, and also because of the future interest rate cuts from the Bank of England as well. So Bank of England's rate cut cycle kind of follows the US rate cut cycle. And I think with more clarity in the US interest rates going forward, we have a little bit more clarity about the UK interest rate as well. So I hope this partly answers your question.
Very good. Thank you. Very clear. Maybe one for Ben as well from me. So you showed us the kind of UK growth forecast numbers. We had the Bank of England come out yesterday, didn't we, with their monetary policy reports. And I think I'm right in saying their growth projections, UK growth projections, are quite a lot higher than ours over the medium term. So I think looking out to 2027, 28, they're more in the like 1.8 region, I think. What's tell us a little bit more about the difference between these two outlooks and what might be driving them.
Absolutely. Thanks, David. So the bank released its MPR yesterday, and they have their growth and inflation forecast. Their inflation forecast is a little bit stickier than ours, with inflation reaching the 2% target slightly later than 2026, where ours falls a little bit faster. But on their growth outlook, in the medium term, in 26 and 27, we're sort of on a similar path. But from 27, mid-27 onwards, growth picks up quite substantially in the bank's forecast. And it reaches 1.7, 1.8 towards the end of the forecast horizon, where we stay as around 1.25%. So this difference in trend growth is quite significant, and it has quite important effects for debt dynamics as well, because we fundamentally have a lower G than the bank does in our forecast. So I think that's one point worth sort of fleshing out, definitely.
Okay. We may come back to get into the assumptions underlying that perhaps in the Q&A. So let's open the floor to questions from our audience. I think I might do these in not necessarily in the order they've arrived. I'll group a few together, I think. So the first question, I think this is a very good question by Peter Gordon. Peter, are you there, and would you like to kind of unmute yourself and ask your question about inflation and debt?
Yes, you can hear me. My question really is, obviously, if you have inflation, that's going to reduce the debt burden, assuming that everything is not index linked. I don't think it is. But on the other, but also markets are going to factor in expectations of inflation. How do you see these two factors panning out?
Thank you, Peter. Ben?
Yeah, no, you're right to point that out, Peter. That's a very valid channel. Between a quarter and 1/3 of UK debt is index linked, so you can't really inflate that away. The remaining sort of 3/4 or 2/3, you could have that effect on. Obviously, inflation comes with costs elsewhere as well. We've already experienced quite a high inflationary episode recently. And you can see the damage that does to living standards. You can see the damage that does to business investment as well. as inflation expectations become slightly elevated and unanchored, this is not really a favorable mechanism with which to meaningfully reduce the debt to GDP ratio and improve the fiscal outlook. Really, that has to come through, I would say, primarily real growth, and also needs to come from a sort of credible consolidation where there's certainty about the path of future tax and spend policy. Also, markets do largely factor in inflation expectations. You can look at the break-evens, and that will also show you where the market is thinking things are going to go. But fundamentally, there is a risk premium on UK debt. The UK has the highest borrowing costs in the G7. If you were to emphasize this inflationary channel again, I can only imagine that would basically push risk premium higher than they already are.
Thank you very much. Let's do another one in a similar space. So this is a question by Rory McQueen. Roy, would you like to unmute yourself and ask your question?
Yeah, hi. And firstly, thanks for great presentation and great outlook to everyone who's worked on it. Just I was wondering how sensitive the findings are in terms of debt sustainability and primary surpluses to the values for R and G, because I would have thought, just very roughly, nominal GDP growth, what, 4 to 5% at the moment, probably the average effective interest rate on government debt may be similar, I don't know. We're probably not far from a line between what you had as red and green zones, tipping over between one and the other, I'd have thought, maybe.
I think it's a great question. Ben, do you want to have a go? I might also bring in Stephen.
Yeah, it's a great question, Rory. Very eagle-eyed. Yeah, so you're right, they're broadly in balance, but this is kind of on the back of a huge inflationary episode as well. So that's really pushed up nominal GDP growth. But if you take a look at our forecast going forward, we've got essentially inflation at target next year, and we've got growth at trend next year. So that really gives you about sort of 3.25% for nominal GDP growth going forward in our forecast. And that's the bit that we're iterating on as well. I mean, you can also look at our sort of, bank rate as well. We have R star at 3.5. There may be a bit of a risk premium on the debt, but you're looking at somewhere in our forecast from 26 onwards as the gap being somewhere between 0.25 and 0.5% between R and G. So that 0.5%, 0.25%, even though it may be small, but it's quite a powerful mechanism when you iterate it over several years, over the end of the parliament. So the kind of magnitude of that gap going forward is in that range.
Thank you. Stephen, is there anything you want to add to that, or are you?
I mean, but Ben's basically done it. The question's linked to the previous one, actually. The reason that we're in a position just at the minute where G is bigger than R in nominal space is because we have relatively high inflation. But as Ben said in his answer to the previous question, inflating the debt away is not a winner in the sense that inflation really does have negative consequences, particularly actually for poorer households. So we don't want to go down that route. And once inflation is back to around target, then unfortunately the growth and real interest rate dynamics do actually turn against the government in the way that Ben described.
Thanks. I think that's a really good question. And Rory, thank you for your you said some nice things about the change of to the format of the outlook this time. So I appreciate that feedback. And I should have actually said at the outset that we have made some changes to try and make it kind of simpler and more direct, easier to read, and with the boxes, I think this time are particularly good. So we would greatly appreciate, from all of you stakeholders, any feedback on things that you like or things that you think we should be doing better on this front. But just to flag, there are some formatting changes this time round. I think I'm going to turn to a question that Catherine asked in the chat. Now, Catherine has also sent me a message saying that she's unfortunately had to leave. So I will ask the question, and sorry, Catherine, you can kind of follow this afterwards to hear the answer to your question. But the question is, what fiscal measures would you recommend to build the buffer that we're proposing of 30 billion? I might ask Stephen whether you want to take that one directly, as you're on my screen at least. So Go ahead.
Yes, I mean it's to build a buffer of 30 billion, that's on top of what is likely to be around about 20 billion that the OBR would say the gap would be pre-measures. That's quite a hefty increase in taxes. And as it's a hefty increase in taxes, I think the Chancellor is going to have to raise one of the main taxes. And given that income tax is the least distortionary of the main taxes, we would argue that that's the one the Chancellor has got to raise. Now, how she actually does that in practice, maybe 2, maybe 3 percentage points on the basic rate, maybe something nearer 5 to 10 percentage points on the higher rates. That will get her at least some of the way towards building that buffer up. She may well wind up raising a lot of other sort of little taxes, if you like. We would advise against that on the grounds that it will make the tax system more complicated, and in terms of the efficiency of revenue raising, it's not as good. So we would advise to use income tax as the way of raising this buffer.
Thank you very much indeed. I'm going to do one more on the fiscal side, and then we'll come back to growth, I think. So this is a question actually from our colleague Ed Cornforth. Again, this is one I will read out. So this is also a good question, I think. What are the benefits of fiscal consolidation? You can also, I guess, think about the costs of not doing it. Is it all to avoid worse situations, or are there any positives here? Ben, why don't you have a stab at that one?
Yeah, thanks, David. Yeah, it's a great question. I mean, any fiscal consolidation in recent history is always usually a combination of measures. So there's a sort of a wide range of tax increases along with spending cuts to sort of find that optimal mix. The benefits of a fiscal consolidation is to ultimately, in the long term, is to lower the risk premium on UK government debt, which, as we know, the 10-year yield is the highest. And if you look at the spreads on UK 10-year yields relative to other G7 members, it has edged up in recent years. So a consolidation of that kind, in conjunction with a clear path forward for tax and spend, and maybe even announcing some kind of intentionality for larger tax reform and simplification of the tax code and measures like that, which could also increase business confidence going forward, so that they know that they're not in for a surprise for another tax increase or spending cut going forward, because businesses really need certainty going forward. And one of the key sort of metrics that's been highlighted again and again is that businesses have very high levels of uncertainty. Part of that's sort of geopolitical, you can't control that, but a large source is also over domestic cost pressures as well. And that's been recently flagged again and again in CFO surveys. So I think the benefits of the consolidation really sort of come from enabling businesses to invest and allow consumers to be sure about what they're doing going forward as well.
Great, thank you, Ben. Maybe a similar question. This is from me to Ahmet again, just so we're having some questions on the global side, because I think there's a lot of interest there. Again, thinking about this kind of uncertainty channel, I thought one of the most fascinating charts in your presentation was the gap between these announced tariffs and the actual implementation. And I guess maybe you could kind of say a little bit more about how you'd like us to interpret that. Should we really just focus on the actual, because in a sense that's the thing hitting the economy in terms of like what people are paying? Or is there more information in the announcements, because of this kind of idea that the announcements themselves are creating uncertainty, preventing businesses from planning, disrupting supply chains, and so on? And what's likely to happen to those two lines going forwards? Do you want to say a little bit more about that fascinating chart you showed us?
Sure, David. Yeah, let me start with how I constructed that chart essentially. So the headline tariff rates are essentially the effective tariff rates, which is the weighted import weighted average of tariff rates of the United States against all other countries. That's what we've been talking about all the time. But the other chart, the actual US tariffs, is the actual tariff revenue that the US authorities collect in the customs as a share of total imports. So why there is difference? Because we use the previous year's weights when we take the effective tariff rate. So, but the market is quite dynamic, and they immediately switch from markets, this market to that market, and also from this good to other good, etc., etc. That's why the effective tariff rates are or headline tariff rates are not a good indicator to capture that kind of dynamism. The actual tariff rates can actually capture that. And there are also lots of exceptions. This good is exempt from those tariffs, and that country has some MFN rules applied, etc., etc. So that's why the actual tariffs are lower than the headline tariff rates. Going forward, what's going to happen is probably we are going to see headline tariff rates or the effective average tariff rates converging to the actual tariff rates. And that's because we will have more clarity about the trade diversion, and we are going to revise our weights from other countries. And we will see lower actual tariffs. But of course, that doesn't mean that tariffs are not that high or they are not so harmful for the economy, etc., etc. We have done a lot of analysis on the impact of tariffs, and almost all works, both from us and also some other works, consistently showed that how harmful these tariffs on US growth, US inflation, and through that the global economy. And also, we should also bear in mind that the current actual tariff rates are already 5 times higher than the global average anyway.
Lovely, thank you. All right, I'd like to turn to George Koutsoumanis. So George, you have a very good question about growth. Would you like to unmute yourself and ask that question?
Can you hear me?
Yes, we can.
Yes, okay, thank you. Thank you very much, and thank you for the great presentation and great report, as usual. My question was if you can just unpack a little bit your growth forecast a little bit more. So you mentioned this difference between 1.75 roughly at the OBR, and you've got 1.25. I think most of that is driven by productivity rather than labor supply. And if I'm understand this correct in your report, you have a productivity growth assumption of about 0.64, which compares to a bank assumption of about 1%, and currently the OBR still has a 1.25. Like there is all this speculation about them bringing it down, but this is certainly a bit of a, let's say, more pessimistic view on labor productivity, right? If you could just say a little bit more about the rationale behind this, like what are the drivers, how you have come to that assumption effectively, that would be very useful. Thank you.
Yeah, thank you very much, George. Great question. I think I'll ask Stephen to address that one. Stephen, you have a nice piece in the report looking at this, so why don't you talk through that?
Yeah, so this is all described in box A. The bottom line is the following. I mean, labor productivity is very hard to predict, and what the trend is a very tough call to make. The best you can do is you can look back at the past. And if I look at labor productivity growth from the peak just ahead of the global financial crisis to now, or there was possibly a slight peak in 23, but if I look at labor productivity growth over that period, then it is averaging only 0.12% a quarter, so 0.5 roughly a year. So as a starting point, that would seem a reasonable place to think of labor productivity growth as growing at trend. Of course, prior to the global financial crisis, if we go the 35 years between 1973 and 2008, then you were getting labor productivity growth of 1.6% a year, which was a lot better. So differences in views between us and the bank and the OBR really amount to what extent do you think the post-global financial crisis period is unusual, and how much further do you want to, how much closer do you want to get to what productivity growth used to be in the past? And to be honest with you, my conservative with a small c assumption is that I see no particular reason at the moment to think that we're going to go back to the rates of productivity growth we saw in the 70s, 80s, and 90s, and indeed thousands. I'd be much more inclined to think that we're going to stay at the rates of productivity growth we've seen over the past 15 years. So our 0.64 is slightly above the 0.5 or so that we've seen since 2008. But I don't see any particular reason to go more than that. One more thing I should say is that a mistake that a lot of people make is they look at productivity growth from the bottom, from the trough of the cycle in 2009 to something to today's number, for instance. And that way, of course, you get a higher productivity growth rate. But then, in a sense, you're kind of cheating, because you know there's going to be higher productivity growth when you're catching up from a trough. So that's why I was very, very careful in the box to look at peak to peak rates of productivity growth. Anyway, obviously because I wrote it, but I would recommend reading the box.
Thank you. George, did that answer your question? Are you happy with that?
Yes, absolutely. I mean, I think this is the way that the OBR as well, and David Miles in particular, has framed this a lot of times before, right? It is this where we think we are on the averaging before the financial crisis and after, and whether we think this post-GFC weakness is now the new normal in a sense, and it seems like this is closer to your view. So that makes perfect sense. Thank you.
Thank you. Yeah, we'll watch what they come out with, obviously with great interest in the next few weeks. I think we've reached the end of the questions, unless anyone else has a final question they want to put in the chat. Perhaps while give you a second to do that, I might just take the opportunity just to emphasize the key message in the report, just so you have the takeaway. So we're kind of saying we expect, we think the OBR will come out with a number in the region of 20 billion, perhaps a little bit more. That's the shortfall relative to the rule. We think there needs to be a buffer over and above that of 30 billion. So that takes you to a fiscal adjustment roughly of the size of 50 billion. We're not advocating in the report how that is done. So we have some analysis saying how you shouldn't do it, some costly taxes that should be used. We think on balance, income tax is a more favorable tax if you are going to lean more heavily on the tax routes. But we're not advocating for a particular income tax rates, or a particular balance between spending and taxes. Ultimately, that's more of a political decision. The key thing for us is this is the time to begin bringing the debt level down to avoid ratcheting up risks in future. Okay, I don't see any more questions, so I think maybe we can draw this to a close. Let me just emphasize, we made some big changes actually to the format this time, so very keen on your feedback and ideas for how we could make it even better still. And I'll just, I think, end with flagging a couple of events that we have coming up that you might be interested in. So next week on the 12th of November, we have a panel discussion in the evening in person at NISA with Charlie Bean, Martin Ellison, and Jack Meaning, looking at exactly this question about the sustainability of the UK's debt position. That should be very topical and very interesting. So certainly encourage you to come along to that. As ever, we'll put these off. Thank you, Neil. I think you've just added the link to that so you can kind of see the details. We'll put it up on the website afterwards, but do encourage you to come in person. And on the 27th, the day after the budget, we have an event, a webinar again, where we'll be trying to unpick what's actually happened and try to assess both the macroeconomic effects and the impacts on financial markets that we might see. So that's the kind of outlook from our side. Thank you all for joining and for the kind of rich discussion, and we will see you in a quarter. Thank you.
Thank you.